Hello, everyone, and welcome back to another episode of the RPAG Scoop. My name is Ashley Passo. I'm the Senior Marketing Specialist here at RPAG, and I'm here to bring you this frosty edition of the December RPAG Scoop. And as we wrap up another fantastic year, we're going to be taking a look ahead at 2025 and what it has in store for our RPAG members as far as events go, both in person and online. But that's not all. We will also be having two very special guests on this episode of The Scoop, talking about investment market trends as well as some strategies that could work for you and your clients. But I'm going to kick us off by going over the events that we're going to have coming up in 2025 that you may not know about. So we will be having a few events, including our national conference, which we have every year, but I want to highlight some that you may not be attending or you haven't attended in the past, but I want to get you really excited about our upcoming events, both digital and in person. So to kick things off, we did have our very first ever Impact Lab in Irvine, California, hosted by Capital Group American Funds in their Irvine campus. This is very different from our other events just because it's a more intimate session. It's roundtables. It is highly collaborative. So you're sitting and you're discussing with other advisors what's going on with your practice. You also get the chance to discuss with our partners what you would like to see from them. And you can also let us know what you're looking for as an advisor. We are hoping to have many more of these Impact Labs coming to you around the country. If you see one near you, I would reserve it as soon as possible just because these spots do tend to fill up faster than others because this is designed to be a smaller crowd. Regional summits. So we normally do 4 of these a year, but this coming year in 2025, we are hosting 5 regional summits. Locations are Dallas, Nashville, Philadelphia, Huntington Beach, and Chicago. So we will be sending out the save the dates soon so you can block it off on your calendars. And then once those are out, get ready for the registrations. I'm so excited for regional summits this year. Can't wait to see everybody. If you're watching this RPAG Scoop, I really hope that you know that we have educational webinars happening constantly around the year so that you can stay informed and up to date with the latest industry trends and solutions in RPAG. Our most recent webinar was talking about strengthening client services, and we had another one with our friends at AllianceBernstein discussing navigating the post-election investments. To find any of these recorded sessions, you can go to our YouTube channel, and then you're going to scroll down and you'll be able to find any of our webinars that we've had in the past. You can also view our past conference videos as well as our summit videos. And if you want to make sure that you're on top of any upcoming webinars, we do have one coming up called Yield is Destiny, but you would have to go to our webinar page of our website if you are not receiving our emails and register for it that way. And you can click on each individual page. Finally, we're going to be hearing from Jonathan Bowman from American Century. He's going to be diving into the value of mid-cap investments, often referred to as the middle child of the investment world. So let's check in with Jonathan to see what the excitement is all about for mid-caps.
Hello, I'm Jonathan Bowman, a Senior Client Portfolio Manager for the U.S. Mid-Cap Growth Team at American Century Investments. On behalf of American Century, I would like to thank RPAG and all the member firms for your partnership and confidence in our mid-cap growth strategy. I'm here today to cover 3 main topics. First, I'll provide some historical perspective on mid-caps relative to large and small caps. Second, I'll provide some insight into how the concentration into a handful of mega-cap companies, often referred to as the Magnificent Seven, in recent years has created an environment where market index exposure to mid-caps has shrunk. Finally, I'll highlight American Century's approach to mid-cap growth investing and why we're excited about the opportunities we're uncovering in the market. If you think about it, mid-caps are sort of like the middle child in some families. They can often be competing with their older and younger siblings for attention. However, if we look back in history, there have been some pretty remarkable middle children that grew up to do big things. Warren Buffett, Bill Gates, Michael Jordan, Martin Luther King Jr., and Abraham Lincoln, for example. In most stick and ball sports, you want to make contact in the middle. Think of a baseball bat, golf club, or a tennis racket. The middle is often called the sweet spot. It's basically the most efficient area where you have the greatest power and accuracy. In investing, mid-caps have proven to be the sweet spot over time. Since the inception of the Russell indexes in 1978, small caps, the dark blue line on this chart, have delivered a solid 11% annualized return. An initial $10,000 investment would have grown to roughly $1.2 million. Not bad. If we look at large caps, as represented by the Russell Top 200, the light blue line, they delivered a 12% return and grew that $10,000 into $1.8 million. Notice small caps were typically outpacing large caps up until the last 6 years or so. The best wealth creation, however, came from mid caps, the dark green line, with a nearly 13% average annual return and more than double the ending value of small caps at over $2.5 million. How have mid caps accumulated such outsized gains? Through consistently outperforming over time. Let's start by looking at the rolling 5-year excess return of mid caps versus small caps. What you see on the top chart is in 89% of the rolling 5-year periods, mid caps beat small caps, and in many periods by multiple percentage points. The average excess 5-year return was 2.2%. We can take the same approach and compare mid caps to large caps. In the bottom chart, the pattern of excess returns is a bit more cyclical, with strong large cap outperformance in the tech bubble and more recently. However, mid caps still beat large caps more than half the time, with an average of 5-year excess return of 0.7%. One interesting point to note is that in those periods where mid caps were trailing large caps, they were usually beating small caps at the same time. Similarly, in the few instances where mid caps have lagged small caps, they've outperformed large caps over the same period. Bottom line, mid caps have rarely been the worst market cap spectrum to be invested in. They tend to hold up better than small caps in periods where larger companies are more in favor, and they outpace large caps when small caps are ripping. Now, why are mid cap companies able to deliver such attractive relative returns over time? Well, if you think of the life cycle of a company, mid caps are the survivors of small cap land, with proven business models, more seasoned management teams, and established customer bases and brands. Yet they still have a lot of runway for growth ahead of them before they become large caps and reach the maturity phase where higher levels of growth are tougher to sustain. With all this great performance over long periods of time, you might think that investors are loaded up with a lot of mid-cap exposure, right? Well, the reality is that many investors may be underexposed to this powerful asset class. Mid-caps account for 23% of the US equity universe, but according to Morningstar, only make up 10% of investors' equity mutual fund assets. Part of the reason for this may be a function of how the Russell 1000 index is made up. Many investors may believe they're getting significant mid-cap exposure through investing in an active or passive manager benchmarked to the Russell 1000 index, because the Russell 1000 is a combination of the 800 names in the Russell Mid-Cap Index and the 200 largest companies that make up the Russell Top 200. This index is like a comet, though, with a lot of weight in the largest companies and relatively little weight spread across the companies toward the lower end of the market cap spectrum. In fact, looking at the image on the left of this slide, the top 200 companies make up 78% of the weight in the index and primarily drive the overall returns of the Russell 1000. Even more concentrated is the largest 25 companies, which make up 44% of the index weight. Looking at the image on the right side of this slide, we can see the concentration in the largest companies is even more pronounced in the Russell 1000 Growth Index. In the growth universe, the top 20% of companies make up 90% of the index, leaving only 10% of the weight to be spread across the other 80% of the names. The 25 largest companies comprise nearly 3/4 of the index weight. So, investors using a Russell 1000 growth manager to get their mid-cap exposure likely aren't getting as much as they think. And it's only gotten worse in the last few years. This slide illustrates the historical weights for the top 200 and mid-cap exposures in both the Russell 1000 Index, which is the top chart, and the Russell 1000 Growth Index, the bottom chart. In both cases, mid-cap exposure in the light blue line is well below historical averages in the yellow dashed line. The shrinking of mid-cap exposure is most pronounced in the Growth Index, where we've never seen an exposure level so low. Now that I've made the argument for why mid-caps should not be ignored, let me spend a few minutes discussing our approach to managing our mid-cap growth strategy at American Century. Our investment process is built around 3 key pillars: themes, quality, and inflection. A thematic approach serves 2 purposes. It allows us to identify opportunities outside the normal confines of sectors and industries and cross-pollinate ideas across the investment team members. It can also provide greater confidence in the durability of financial improvement for those companies benefiting from a secular theme. One example of a current theme in the portfolio where we see opportunities across sectors and industries is artificial intelligence. While large cap companies' exposure to this theme have received most of the market's attention, We're excited by the opportunities we're seeing. Within midcap, AI is often more embedded or a use case versus being its own product as it is in large cap. We see AI as product enhancing, productivity improving, or as a supply chain component that goes into large cap solutions. For example, this has led us to companies that are using AI to make drug discovery more efficient or online advertisements more targeted. We've also identified attractive companies in and outside of the technology sector that help power and cool data centers or provide the electrical connections or custom semiconductors that make AI possible. We look for companies aligned with these themes that have durable franchises with strong management, leading products, and superior business models that can deliver more attractive returns on capital. We use deep, fundamental bottom-up research to identify inflections or changes in a company's growth or margin trajectory that offer an attractive entry point into stocks where the market may be slow to recognize the magnitude and duration of the company's fundamental improvement. This combination of a top-down thematic approach with bottom-up fundamental research is conducted by an experienced team of sector specialists that spend all their time focused on mid-cap growth investing. In the more technical areas of the investment universe, such as healthcare and technology, we have team members with industry practitioner experience. For example, our technology analyst has a master's degree in electrical engineering and worked for multiple technology companies before earning his MBA. Our healthcare analyst is a medical doctor with a degree in economics. The result of this collaborative investment process is a portfolio of 70 to 90 stocks that is size and style consistent, where the majority of active risk and excess return is driven by stock selection versus large macro or sector tilts. In summary, mid-caps are often overlooked, but have outperformed over time. We believe investors should be looking to add mid-cap growth exposure to, at a minimum, offset the reduction in exposure they have likely seen because of the market concentration in recent years. If the market continues to broaden beyond the Magnificent Seven stocks, like we've seen recently, we believe mid-caps could continue to benefit. Our approach, focused on identifying quality companies with improving fundamentals aligned with secular themes, provides a unique approach to this attractive asset class. So don't ignore these investment middle children. They could achieve great things in the future, just like they have in the past. If you have any additional questions or would like to set up a call, please reach out to your local American Century Regional Retirement Consultant. We would be happy to provide you further information. Again, thank you for your partnership and have a great day.
Thank you so much, Jonathan. We really appreciate you being on the Scoop today. And we also want to thank every single person who's been watching the Scoop this entire year. We're wrapping up 2024. We're very grateful for everyone. And we can't wait to see you next year for the new and improved RPAG Scoop. You will see us in a whole new light. But until then, have a very warm and joyful holiday season, and we will see you next month.